This is London with MarketHedge. I appreciate the feedback from yesterday in terms of the specific hedge on the 20 moving average. One of the trades, guys, 150K right now on Bitcoin. The other one, about a 50K. So we're looking at about 200 grand at risk right now in the accounts. Let's go over what we discussed yesterday, okay, in terms of the macro consideration and hedging the 20 moving average. Why do I want to cover it again? First of all, if you didn't catch the hedge 20 moving average, which is the specific yellow line, that yellow-orange line in the middle on the 4-hourly time frame, part of the Bollinger Band setup, classic. I want to go over the specific instances here. What do you see? You see some nice hedges. Okay, now I'm going to call these hedges because yesterday, and please rewatch the video, appreciate the feedback as well in the comments. Hedges would mean, a hedge would mean we're stacking underneath the specific 20 moving average, right? And how many of these paid? 1, 2, you got it, 3, and then we've got 4. Bam. So we've got that 1, 2, 3, 4. Let's take a look at each of these just briefly. I want to cover this since we just did go over this on the preceding video. We'll go over a few additional technicals. That's about a $500 move there. We're looking at that next wick at about a $1,000 move. Not bad, guys, 0.8. The next one, about a 0.8. The next one, about a $1,000 move. Then we have the specific hedge from the upside, which would be what? Which would be shorts, which paid in the instance, right? The lower ones, longs picked up and paid. Longs picked up and paid. We got longs picking up and paying. Again, longs picking up and paying, right? Over, what do we have? You got it, guys. We've got shorts that are picking up, that are stacked. Traders are stacked, and it pays upon the return. So we're back in long territory. The trick with this is, first of all, adjusting the way that you're viewing your charts, seeing the specific equation at hand. This is about an $800 move down, just for the record. But seeing the equation at hand and understanding the following. If and to the extent, please pay attention, if and to the extent that we would choose to hedge right underneath the 20 moving average by stacking orders, that's where MarketHedge Pro comes in, guys. Okay, in terms of stacking orders underneath that 20 moving average or stacking shorts over, right, stacking longs under or shorts over to capture that return throwback to the 20, right, from under. The longs pay, the shorts pay. The longs pay, the shorts pay. The longs pay, you got it, longs pay, shorts, longs. You got the shorts paying. Now we're back in and have been in long turf, so we're back in that same zone. The trick is what? It becomes an issue of exposure. Now, we didn't talk about risk management yesterday, but as you can begin to formulate this in your mind in terms of the profit equation, this is where excellent traders put time into risk exposure, right? And I always say to traders, and this is London, former hedge fund owner, private, non-SEC, not financial advice. I tell traders it's not a matter of if you're going to make money. It's just a matter of how much. Now, let's unwrap that or unwind that statement. When I say it's not a matter of if you're going to make money, it is a foregone conclusion. There is at least a much higher degree of certainty that you can make money in the market. What complicates that specific near certainty, right? What complicates it is too much exposure, right? So that second part of the equation, right, the biggest question is, the only question is, how much are you going to make? Why? Because that's where traders start to put in too much money, right? It's not a question if they had lightened up, really lightened up in terms of their exposure, in terms of their margin, in terms of their leverage. The equation, I can draft an equation that with really small exposure, every trade's going to be covered. You guys know that. So it's not a matter or question of if you're going to make money. It's a question of, and this is what gets traders in the red, is how much. And that question, as you start to look at how much do I want to make on these hedges? Guys, they're swing trades, right? But these are hedges back to a primary indicated line, that 20 moving average. And the question of how much is the question that gets the traders, right, in a heap of trouble, right? Gets them kicked out of the market. So that's the way that I think about this scenario here. And it's more of an issue of, can you stack your orders with enough discipline to where you're not trying to make I want to make 50 grand. If you were to say, I want to make $50,000 on every single return to the 20 moving average. Whoa, buddy. Whoa, buddy. Okay? You want to make 50 grand on every return of Bitcoin. Whoa, buddy. Okay? When you're talking about, well, okay, and again, that's the question of how much. Not a question of if I'm going to make money. I know we're going to return to a line, or let's say this, with the smallest amount of exposure, I can always cover a preceding position. With heavy backup cash, I can always step in with enough cash and cover a preceding position. You guys know that. But that question, if that second question, how much? That's why I focus on that. It's only a question of how much. The guy who steps in and wants to make 50 grand on every single return to that 20 moving average, whoa, buddy. Whoa, buddy. Okay, you better have pockets the size of a foundation on a nice building in Manhattan for that. I'm telling you guys, and guys who trade that heavy, they know, right? So, but if you're looking at it and say, okay, why don't I start off, and the process really started in here, but what if I'm trying to make $250? Okay, now you're starting to talk while you can at least get the process together, while you can at least start to see, okay, how would I make $250 over, under, over? We're back under. All of these swing trades, these hedges, as we're going to call them, and it's just, I wanted to focus on this again, not to be repetitive, but just to reinforce, look at these hedges. We called it out. Now, someone can make a lot more than $50,000 on a return to this specific 20 moving average. You guys agree? You put enough cash in, you can make that. At some point, guys, the market maker is going to want to run home with that cash account. I'm going to tell you, you know that. He's going to at least push that $50,000 potential into a bit of a bind. He's going to say, what does it bother him to say, well, why don't I go back down to this flat bottom here? Now the trader's got what? He's got a lot more than the 50K. He's got 100K in exposure, right? And then if he's going to cover, let's just talk it out. If he's going to cover the overall larger pattern, which you see on the right-hand side, well, that 50K just turned into what? Well, the trader actually needed 100K to cover it, to keep in play, right? And then actually, and this is where things get dangerous, the market maker's going to push you around like you're a real player, and you betcha, he's going to go for a measured move down, and now you're about, let's call it $250,000, 300,000 in the bank. You guys got it in whose bank? Probably the market makers. If you're overexposed, and the guys who are pushing for 50 here may be in the whole $500,000 here. So how do we fix that? Well, it's that second question. It's not if you can make money, it's how much. And so as you guys are looking at hedging, the first trick is to, let's say the first rule is to understand the charts. See what's going on before you so that you can discern, okay, where is the money being made? Right? Then ask yourself the question of, okay, if you want to participate, how much do you need to make? So I want you guys to please focus on that. We've got great technicals to have this discussion. I know it's a little bit lengthy, but for the guys who are listening, I want you to focus on, if you can, just focus on that question, okay, how much? Then you can start to rationally compute, and don't worry about the figures. Rationally compute, okay, if I'm stacking under, if I'm stacking over, yeah, I'm starting to see these are hedges. Bam, to the 20. Hedge back to the 20. Hedge. You're seeing why as well. If you review that, you're seeing why we stack, right? Because we're not maxed out on exposure at a top line order. So we're hedging, we're drawing back our margin exposure, and as long as we're returning to that 20, we're guaranteed to catch that specific bottom, right, or that specific top. So this is another primer. I wanted to highlight these specific candle wicks and talk to you about just what I say. It's not a question of whether or not you're going to make money. The question is how much money. And that second part of the question, you guys know, can get the traders. That's the one that really gets the traders, right? Being too aggressive. Now, in terms of the technicals, you guys have got it. Nothing's really changed. We're still on that hedge, 20 moving average on the 4 hourly. We've got levels of interest down through and up to, 135. You guys know that's the trigger, right? Pull the trigger at 135. That'll be me. In terms of the downside target, preceding flat top resistance, Bitcoin is doing what? It's paying those 4 hourly 20 moving average hedges. That's what's going on. So in the slow times, watch that 4 hourly 20 moving average. Guys, this is London with MarketHedge Pro. Appreciate all the comments, and guys, we'll talk to you soon. Take care. Bye-bye.